Welcome to the SAICA Biz Impact Podcast, your ultimate business growth platform, where we simplify complex business topics with expert insights, market-relevant trends, and practical advice, all aimed at keeping you ahead of the curve.
Welcome to the SAICA Biz Impact Podcast Show. I am your host, Luncedo Mthwendwe. This is your home where we unpack and simplify complex business topics that affect your business on a day-to-day basis. And we will be bringing you a number of experts that are actually going to share the latest business trends and provide you with insights to ensure that you stay ahead of your business curve. And our topic today, it is a topic that affects not only small businesses, but even large businesses as well. And it is about valuations. It is about valuing a company. And what does that entail? And how does it impact you? We've seen a number of businesses, not only in South Africa, but globally, where you find that an entity, it is a startup, but already it is valuing more than $1 billion. And how does that happen? And, you know, the reality of that as well in South Africa. So we have our expert today, that is Eben Mare, who is the director at Finman Capital. Eben, welcome on board.
Thank you, Lou. It's a pleasure to be here, and thank you for inviting me on your show.
Absolutely. Eben, as I said earlier on my intro, we have a situation where when you read, you'll hear that some of the companies have raised number of billions, as a seed capital or as a startup capital. However, sometimes you'll pick up some of these companies have not yet even traded. And that would have been as a result of the valuation, how much they're valued at. And you start to ask yourself sometimes, okay, can I have a startup that can be valued at $1 billion just within like a year or two? And we need to unpack that for us in terms of how does that work? What is valuation, and what are the reasons why a company would need to undergo evaluation?
Okay. There's a lot in that question.
Yeah.
But let me break it down. Maybe let's start with a little bit of the background to evaluation. Evaluation ultimately is between two parties that want to know how much this thing that they're arguing about who's buying and who's selling, how much is that worth? Because they need to find middle ground and get to a space where they're both equally uncomfortable with the value being paid and received. Very technical, different methods of valuations. You can go from net asset value to multiples on earnings, those kind of things. But ultimately, it's really the meeting of two parties as to this is what we agree on something is worth. So that's the background to evaluation. And you normally go through the valuations to either raise capital or to do loan funding, because the banks would like to know how much is the asset that you're basically putting up as security for the loan being received in the entity. Or there's an equity event. Equity events, change of shareholders. That's either one of the directors is selling out to the remaining directors, or a new director is coming in, shareholders coming in, or it's that you're selling the whole business to another company. The point being is there are various reasons why you go through a business valuation. But to get back to your opening remark around how a tech startup can land up with a few billion dollars.
And it's happening quite a lot lately, right?
It is, but it's because of the exciting times that we live in. AI and the advent of technology advancement is just phenomenal in terms of the curve that you're seeing. So people are finding new ways to do things in the past so much faster. And then the different technologies are starting to merge. So if someone finds a way to merge new technologies, and it is this tech startup, and you've got basically, you figured out a way that the fridge talks to the front door of the retail store, talks to how many people actually went by that aisle and picked up that specific product. If you can sell that idea to people that understand and can see how you can monetize the idea, You don't need the history. You just need to prove that the idea works. And if it's something that is a differentiator, it's unique, no one else is doing it, that's then what drives these multiples in terms of business valuations, and especially if it's scalable. So what you have is that at the moment in the US, Europe, especially in China's got massive population, US has got a massive population. So where you've got a big demographic that you sell your product into, it's tech driven and it goes to a lot of people. Doesn't necessarily need to be high value per transaction, but if there's a lot of transactions and that generates the revenue, that's what people buy into.
No, look, you've given me a very good. It's exciting. It's exciting because I'm trying to think about it. In First World, you said, look, if you have an idea and you can sort of like project that idea that it will be feasible. However, when you come, let me bring it closer to home. When you are looking for funding, let's say even from the bank's point of view, they always look at what? The history. All right, they look at the history. They don't care about your idea. There's so many young people that are out there that have so much ideas. And most of the time you find that they get blocked because of the fact that they don't have a trading history. And you are picking up in other economies. You don't need that trading history. All you need is to show that forecast that this idea will work. So why are we having such issues in South Africa where we're still stuck on the fact that show us your 5 years, 6 years trading history before we give you a funding point of view of like 5 million or 10 million?
Very good question. The interesting part, and in answer to your question, is that there are two ways of looking at how you get money for your business. The one is from the bank. The bank is risk averse and the bank's trying to cover what they are loaning. So they need to see the security for what they're advancing as a loan. That's why they're looking for the history, because it's the best predictor of the future.
Correct.
They're risk averse. That's why the bank wants you to show the history so that they can say, okay, we're happy to advance the following to you. But that second tier of funding is actually from venture capitalists. Or that is people who are looking for a higher delta, so a higher growth change in value. And they specifically look for startups. There are people in the world, high net worth individuals, private equity firms, venture capital firms, they are constantly looking for not what's the run rate, put your money in the bank and what's the interest I can earn. They're looking for something that outperforms that, but by a lot. And they would go into maybe 50 different investments, of which 2 come off. But they come off in such a big way that the 2 pays for the 48 that didn't come off. And then some. So it's for those individuals that you would make the pitch, or those companies that you would make a pitch that says, this is the idea, this is how we show that it can work, this is how we're going to monetize it and how it's going to make money. Buy into our idea. And they buy into the team, they buy into the vision, and they buy into the possibility. And that's where that comes through. Interestingly, sorry, just to bring it closer to home to your point, in South Africa a while ago, that didn't really exist. If you couldn't get a bank loan, you didn't have a rich uncle or someone that you could go to and say, can you spot me a few $100,000? You didn't really have a lot of legs. So what a lot of the businessmen in South Africa started recognizing was that we don't have formalized institutions. And there's a few people who started building those venture capital funds that specifically looked at fintech startup companies. And there are a few successes. We're not going to go into some of the names necessarily, but there are a few wonderful successes in the South African market where they are supporting new businesses, new entrepreneurs that come up with cracking ideas. That's internationally scalable. And that's the beauty.
No, that's great. So in terms of valuation, what does the valuation exercise tell you as a business owner or as an investor that might be different from the business plan. A business plan, you write it, of course, you list each and everything. But evaluation, of course, is an exercise. As you said, it's an exercise to value that the company is X amount currently. So in a nutshell, from an SME owner right there who's listening to this podcast, and then someone has told you that, you've told them that you need to do evaluation for a company. But in a nutshell, what does the valuation exercise tell you as a business owner?
Taking a step back, evaluation exercise has got a component that is just math.
Yeah.
You know, there's a formula, it spits out a number, and that's the number.
Yeah, that's just the number, yeah.
But valuations actually have a little bit of art to it as well. So there's the mathematical science to it, and then you've got an art component to it. And that is actually articulating what the numbers tell you. And the numbers are telling you something about the past, but it's also telling you something about where we are expecting this thing to grow and into the future. So it's a forward-looking, as at this moment, how do I do the valuation? So it depends on which valuation you're using. If you're using a backwards looking one or a net asset value, it's a point in time. If you're doing a cash flow forecast, and therefore it's the consistent earnings that you applying a multiple to, then it's basically a forward-looking picture that's got a component to it. But what that valuation tells you is that if a buying and a selling party agrees, they're both equally uncomfortable about what the number is. And they go, okay, I think 7, I think 5. Okay, after a few haggles, they get to 6 in the middle. That 6 doesn't represent anything other than the agreement between the two parties.
So it gives you a certain level of negotiation somehow between those two parties. But what happens, okay, now, before we go further, because we spoke about it has a bit of art in it, all right? Now, that art, can I value my company myself, or else I will need now a CA to come and do the valuation for me? And I'm thinking about now as an SME owner, all right? I want to go and get funding. I want to go and get investors. And I don't have funds to go and get an expert, because it appears as if there is a bit of element of maths, as you said, to create the value of that. Now, can an independent party come on board and assist to do the valuation, or else I can do the valuation myself as a business owner for my business?
So if you've got a financial model, you've got the framework, it's in an Excel spreadsheet, you've Googled it, you can plug in the numbers that you've got. Perfect. It spits out a number at the bottom, say it's an EBITDA multiple. Great, there you go. I've got an EBITDA multiple. It tells me 5 Rand or 10 Rand using ARB numbers. The thing is where the independent expert helps is that we get to see industry practice. We get to see what other people are doing. We get to deal with parties who've settled on similar deals and agree multiples of that EBITDA. So that starts becoming market norm. You've got a range. So we can comment on that, which you wouldn't necessarily know about because you don't know all the companies necessarily that's out there doing transactions. Private equity firms, venture capitalists, they're quite close to those multiples, so they can talk to it. But a valuations expert's going to come and sit down with the business owner and say, tell me about what your plans are. Tell me about where you've come from. What is it that makes your company tick? And sometimes what happens is the owner of the business sees the cash that they generate and they think that's the value of their business. And most often, the value of their business in terms of selling it is actually the proposition of why this thing makes money in the first place. And it's articulating how your business makes money and tying those qualitative facts into the quantitative metrics. And then bringing the two together to do a holistic pitch. And that's really where we come in, is we've seen a few things around over the years, and we've seen how businesses value them. You've seen from retail to tech to financial, and then industrial. And they all have a different flavor to them, and they have different deltas that could give more growth into the future. And if they do X, Y, and Z, there's more efficiency, or there's new sales pipelines. And it's stimulating those thoughts with the business owner that then helps them articulate what they actually have.
Yeah. Can I come in there? You mentioned a very important point that most of these transactions, there will be that independent party that will value that company before someone invests, right? Now, there is a company in South Africa that went across in Africa, bought a company, a valuation was done, bought the company, right? The value was X, good, they paid the amount, acquired the business. Then after a year down the line, they realized, no, this company is not valued at this amount. We overpaid for the value of this company. Now you write off the value of all of the company. You paid R1 billion. You realize at year end, when you started to operate this company, no, this company is worth actually about 300 million rands. Now you have written off 700 million rands in your financial statement. Now, what is the recourse that I have as me as a person who wanted to buy a company, and there was an independent expert? They told us, we agreed, okay, the company is worth R1 billion. You operate a year down the line. No, that's not the case, right? Because remember, you relied now on that expert. What happens? What is the recourse that you have from that point of view?
So ultimately, what it boils down to is when you've got two parties trying to agree on a value, when they agree on the value, that's the value that they pay. If you overpaid, it means as the buyer, you didn't do your homework well enough. And if you were on the fortunate side as the seller to get more than what you should have, you did well. So it depends on how the sale agreement was put together. If there is recourse, and normally there's a warranty, there's a whole bunch of warranties that a seller would normally provide in the sale agreement. So your legal recompense would be against the seller.
Okay.
On the independent advisors, unless there is a very specific clause about judgment, the recourse is against the seller from the buyer side. And if the seller feels that they undersold, that's just good negotiation from the buyer. Then there's normally not really recourse. The recourse normally centers around legal principles, not so much valuation principles, unless the legal element has got a tie into the valuation. And then normally there's a clawback clause and there's a timeline attached to it. So that's how those recourses normally work. Is there liability for the advisor? It's possible if there was negligence. But most of the time, and that's why as chartered accountants, we've got that professional code of conduct that we need to conduct ourselves in a certain manner. And it's part of what we stand for as chartered accountants in South Africa and the globe over as accounting professionals, is about a certain standard of professionalism that can be relied on because you know that you get the care and diligence in the performance of the work.
Absolutely. So how can a business owner prepare for their company to go through the valuation process? What are the documents? What is the financial information that is typically required to go through this process?
It depends on the depth and the type of reason why you are doing the valuation. If you're doing it for the bank is going to be interested in your historical financials. That's your annual financial statements. They most likely will ask for audited financial statements, not just accountant prepared. That in itself is quite a process, but we won't get into that. But your historical financial statements, management accounts normally supplements your financial statements, and that's because it's got a little bit more detail just by line item. And then there would be a business case, a forward-looking business case, so a budget combined with maybe a further few years in outlook. So say, for instance, you budget for the year ahead, you would probably want a 5-year plan that looks forward into the future 5 years. And then those are the main building blocks for your financial information that support your valuation. Then you start with the supplementary information. You got to support why you're going to get the revenue that you have. You either have a contract in place or you've got widgets that you sell and they cost X per widget. You pay so much to make them. And that's the support of what's in the financials, what's in the management accounts, and in your forward-looking plan.
Yeah.
So if that's contracts, legal contracts, you need your statutory documentation if you're selling your shares, because it's a transfer of a security. But the base fundamentals of a valuation is your financial statements, your management accounts.
Then that's very important, because it talks to the importance of any business owner out there to have the accountant, stay on the course, prepare your monthly management accounts at all times. Don't fall behind, because an opportunity will come to find that your house is not in order. And now, talking about that, what role can a CA? You spoke about a CA. Of course, you'll come at an ethical point of view, and advise the entity. So, what role does a CA, or what role can a CA help a business to really assess, the value of the company, the due diligence, and all of that process that will assist the entity to get the best value when it is valuing its company, or it is at a negotiation phase?
So I think there's a few different roles that CAs can play in that process that you're describing.
Yeah.
The first and foremost one is where, either as the external auditor or the internal lead of finance, to make sure that the accounts are accurate, that they are up to date.
Don't lie. Don't lie. Don't lie. The numbers must be correct.
They need to be right.
Yeah.
So that's one type of role. So that's the preparer of the financials. That's inside the company, or that can be an outsourced function. Then you've got external auditors. They're providing the assurance to the attest function. So they attest that the numbers are correct in their independent and objective opinion. Then come in advisors like ourselves, and we would sit down with the company and we would understand if they are the buyers or the sellers of a proposed transaction, and then we would understand what their intent is behind it. A buyer would always want to pay the least amount of money for what they're buying, and the seller wants the most amount of money.
The most, yeah.
And the science is getting the two parties to actually agree on a number and then make the deal happen.
Yeah.
So in that process, in the advisory side, it depends on if you're on the sell side or the buy side of this transaction. And then you come in and you work through the company in terms of what is the most apt valuation, because there are a plethora of different types of valuations. And you need to work with the business. You prepare a few. If you're selling, the seller is not necessarily going to go straight away for the one that you propose is the best way to value the company. There'll be a haggling between the two parties, and ultimately you decide on a type of valuation. Then you perform the valuation, and then you go through the merits. Once a decision's made in principle to proceed with a deal, then you'll go into a due diligence, which is a financial due diligence. Both parties will have their advisors looking at the numbers. And you want an objective eye so that you don't land up staring at your own navel, where you're too close to the detail and you want to see what you want to see, as opposed to what's really there.
You spoke about there will be certain methods that are used in valuations, right? And I want you to advise some of the business owners out there in terms of what are some of the methods and the approaches that are used to value a company. Because you'll have now an expert coming in saying, we'll use DCF, or else a discounted cash flow. We'll use this method called net asset value. Now remember, the entrepreneur by that time, they know nothing about all of those terms that we've just mentioned. However, there should be a method that becomes maybe the basic principle, so that you are not left, or you're not in a situation where you feel like, my company is not correctly valued. They should have used either the net asset value point of view. So which one would you say, as an SME owner or as a business owner, either try to use this method or try to use this method? Or when do you use, which method to use as when?
Look, it's how long's a piece of string? Because that's a tricky answer. So you already touched on two different methods. Discounted cash flow, that's basically your forward-looking cash flows. Discounted to today's value. What does that look like? That gives you a number.
Yeah.
Net asset value is basically if I take all my assets, all my liabilities, deduct it from them, what am I left with? That's my net asset value.
Yeah.
Now, depending on what you're selling, if it's a going concern versus this business is ceasing and someone just wants to buy the assets. If someone wants to buy a business just for what's in there, they can go net asset value. If they are interested in the operations and they think they can scale it, then you're more within the territory of a DCF. But there are companies that have bought other entities on a revenue multiple.
Okay.
So they go, you make 100 million rand a year in sales, I'm willing to pay you a multiple of 1.5. So it's 150 million, I'm buying the company. It's because the buyer, his intent behind buying this business is for the revenue.
Yeah.
That might be for market share, that might be for customer penetration because they weren't selling to those particular customers. It can be for a variety of reasons, but that's, for instance, a different valuation method.
Yeah.
Most frequently used at the moment in the private equity and venture capital space is an EBITDA multiple.
Okay.
EBITDA is basically your cash flow.
Yeah.
So earnings before interest, tax, depreciation, and amortization. That's what the EBITDA stands for.
Yeah.
And then there's a multiple based on the earnings that this entity generates. The higher the earnings, return on sales, the higher the multiple.
Yeah.
If it's got a beneficial structuring component to it, maybe that ratchets up the multiple. So if you land up, say, with a 5 multiple, but this is a very high yield investment in terms of buying this company, it's going to be a good yield on your investment. Say it makes 40% on sales. That's high. That multiple wouldn't be 5. You'd probably look at somewhere between a 7 and 8, depending on the industry.
Yep.
So EBITDA, because it's a cash-focused valuation, is a very commonly used one.
Okay.
And that's something that people can read up on.
Yeah.
I would certainly suggest, just to your earlier point, for SME owners,
Yeah.
before you engage with an advisor, just do your homework from a Google perspective.
Understand. Yeah.
Understand the language and the definitions. Because it's very important that if you don't have someone that's a CASA that you can ask and trust, that you just do your homework so that you hear the language being used if it aligns with your expectation.
And it's not only just about becoming an expert on it, but have the basic understanding to be able to engage in a discussion so that you're not left off in a situation where you hear all of the terms, then they confuse you, right? So now, what are some of the challenges and the complexities that, you would encounter when you are valuing an SME business, especially that might be operating in some of with unique characteristics or unique industries or so?
I think in our experience, one of the biggest challenges is the disconnect between expectation and reality.
Yeah.
Where someone's expecting that their business is worth 100 million rand. You go through the detail, you work through the numbers, and you come out, say, with 60 million.
They'll fight you. Right?
They'll say, well, it's 100 million. And you say, well, it's difficult to substantiate your 100 million. Can you share more? And it's in bridging that expectation gap, because you can't breach it just with a good story. You need to support.
It needs to be supported by the numbers. Then the facts have to be there.
By facts. So that's the beauty of what we're busy with. It's a factual valuation that you then give qualitative considerations to. And that's when you bring it all together for a very good final product. And that's our biggest challenge, is sometimes the expectation either too high or too low, depending on if you're buying or selling. That's a big challenge. And then if someone's got massive growth plans, it's one of the other most frequent challenges, is that they gung-ho about the future. They want to raise money with a venture capital firm. So of course this is the best story. It's the best thing since sliced bread. It's substantiating how you're going to grow. Because it's one thing thinking about, I want to do this. But if you can't demonstrate that you've at least achieved some of what you're articulating, and here is the facts that supports that growth strategy, that's very difficult.
That pushes me to a point that as a business owner, this exercise of even scaling up, this exercise of valuing your company, it's not something that you can do it by yourself only. You need a number of trusted business advisors that are going to be able to assist you, so that even when you get to the funders or the investors, the story you're talking about, the facts are there. They can be backed up.
Yes.
You would have done your homework to the T to ensure that you're not heavily exposed when it comes to the negotiation phase. Now, Eben, in terms of, I can see that you've been in the game for quite some time. Can you provide us with some insights, and some of the tips around, the business valuation process, of course, with the support of a CA? What can you impart with, the SME owners there, or even big companies that are out there? Because at the end of the day, it's not only SMEs that need funding, even big companies. They do need, they do go through this process as well. What are some of the tips that you can share with them?
So I think first and foremost is have your house in order.
What do you mean by that?
So accurate accounts, accurate information that is readily available. So your information is always up to date. You know where your incorporation documents are. You know how to support your biggest revenue contract with the actual contract. It is filed, it's scanned. You're up to date with your taxes. You've got a tax clearance certificate. Those things sound mundane, but the administration takes some time. You can't make a pig look different by putting lipstick on it.
Yep.
It's a horrible saying, but the point is that you can't make your company look like something that it isn't.
It's not,
So make sure that your facts and your administration supports what you're putting forward. That's a very big tip. And then I would suggest that people understand why they want to do the valuation. Think through, why are you doing this? What's the end goal, and what do I want out of it? The reason why I say that is then you start formulating an expectation in your head as to what you want. And then when you get something in return from the advisor, you can now measure against your expectation.
Correct.
Now you can have a conversation. Whereas if it's just blindly going into evaluation and the spreadsheet spits out a number, you don't know if that's right or wrong because you didn't have an expectation. So understand why you're doing it. Thirdly, make sure that the partners that you are using are trusted individuals that you are going to walk a road with.
Long term,
So in our situation, we measure our success not on whether or not we manage to complete the project on time and we manage to get all the billings in on time and, not sitting with a big debtors book. We measure as to whether or not we have repeat business with our clients. We don't want many clients. We want good clients that we have a relationship with. And that comes down to trust. And that would be my last or third tip would be make sure that the person that's standing beside you is someone that you trust and they think the same as you and they understand what your goals are.
Eben, before I let you go, I've got one last question. You spoke about you need to have very good trusted advisors.
Yes.
Now, and I'm thinking that to get the value that I'm getting from you right now is not sometimes a cheap exercise. The usual say, if you want to get a quality item, you need to be able to invest and spend on it. It doesn't come cheap. So now this process that you're talking about is very important for the business because it can take them to another level.
Yes.
If they are using the right partners, your CAs that are out there. So in terms of the price, how expensive this process is, thinking to a gentleman who's just running R1 million entity, he wants to scale it to 100 million. Is it an expensive exercise? Value-wise, what are we talking about here?
It depends. It depends on the complexity of the valuation and to what extent the advisor is involved in the negotiation. So it's very difficult to give you a price because it's not a standard item.
Yeah.
It's not like a can of Coke.
Yeah.
A valuation isn't a can of Coke.
Yeah.
It can be a 2 liter. It can be a 6-pack. It can be the whole 24, depending on how you do the deal.
Yeah.
So it's very difficult to answer the question. But let me say this.
Yeah.
I have been in the past in situations where people come back to you and say, whoa, that's way too expensive. You go, okay, but let me help you understand and unpack something.
Yeah.
Is a CA, a chartered accountant, if everything went right, it takes you 7 years to qualify.
Yeah.
After you start your first year at varsity, depending on how you go through varsity, but you're going to be 4 years at varsity, you're going to do 3 years articles, you're going to write board exam, and if everything goes well, it's about 7 years and then you're a CA.
Yeah. Yeah.
South African CAs are schooled from the get-go. Their undergrad needs to be in accounting, auditing, tax, financial management.
Yeah.
In the UK, for instance, you can have your undergrad as history. You only do your financial studies as a 1-year course. I'm not saying that that's a bad thing, but the South African ones, you've got a 7-year base that every CA
it's a rigorous
shares.
training. Yeah,
exactly.
It's a rigorous training.
Now you add on top of that, I've had almost, 20 years, my own experience in listed private environments. So listed environments, listed companies, private companies, financial positions, operational positions.
Yeah.
What happens with that is over the years, you build up experience, which allows you to do certain things a lot quicker because of the 20 years that you've been doing it.
Yeah.
So now you can get someone something in about a year, in an hour, that would take a newly qualified CA a little bit longer to get to because they haven't seen this. Yeah. The point being is you're paying for two things. You're paying for a qualification, so that's an excellent standard, a trusted standard for chartered accountants in South Africa, and they are rated very highly globally. Yeah. Add to that then the experience. Now you're paying for the experience as well.
Absolutely. I get you. So
and that's why it can be expensive.
I get you. So just tell us about your company as well, Finman Capital, and what services are you providing and how you can help some of the businesses that are out there.
So we're quite broad in terms of our offering, but it's predominantly focused on bespoke financial management solutions. Okay. That sounds horribly intricate, but basically what it is that we want to be a trusted advisor to your business and partner with your business to help solve for your challenges. Yeah. And that's what we focus. We focus on business efficiencies, some restructuring, some advice around these kind of things, valuations. Yeah. And that's the kind of thing that we do. We'll even do some outsourced financing services too.
Eben, this has been such a fascinating topic, and I'm hoping that number of SMEs out there, even number of big corporates, would have taken some pointers in terms of how to really go about in terms of valuation. Even capital raising going forward is part and parcel of that. That's it for me, Uluncedo Mthwendwe. I hope you will implement what Eben has said. And let us know what you thought of this episode, and you follow us as SAICA on LinkedIn, Twitter, Instagram. Don't forget to share the content with the people that you know might benefit from it. Subscribe and like the page below. That's it from me, Uluncedo. See you on the next one.
The SAICA Biz Impact Podcast is proudly brought to you by SAICA, committed to growing impactful businesses in collaboration with our SAICA accredited practitioners. Don't forget to subscribe to our podcast and visit our website for more valuable resources.